A shift in financial reporting to IFRS 17 is underway, representing a significant accounting change that has upended comparisons within the reinsurance market. Here to discuss these changes is Antonietta Iachetta, Senior Financial Analyst, and Mahesh Mistry, Senior Director and Head of Analytics in AM Best London office. And Antonietta, let's start with you. How long has this shift from IFRS 4 to IFRS 17 been underway, and how key is it?
The shift to IFRS 17, as we know it now, has been part of a larger project that started back in the late 80s, and that resulted with IFRS 4 being introduced in 2004 as an interim standard, which was meant to limit changes to existing accounting practices. IFRS 4 allowed insurers to continue using their then existing local gaps for insurance contracts, but different accounting policies were therefore used to measure similar insurance contracts in different countries, and possibly even for the same contracts in the same country reported by different insurers. In addition, insurance accounting often was inconsistent with accounting in other economic sectors, therefore limiting comparability. IFRS 17 is key because it provides consistent principles for all aspects of accounting for insurance contracts across all IFRS territories. It removes existing inconsistencies and enables investors, analysts, and others to more meaningfully compare companies, contracts, and industries.
Now, under this new approach, insurance revenue will become a key benchmark and replace the more widely known premium written. How do these two differ?
Insurance revenue, unlike premium written, includes the amortization into revenue of provisions that, at inception, sum to premiums, in a similar way to how the UPR is typically amortized into revenue for non-life earned premium in IFRS 4. It's therefore an earned premium concept, and its use as the top line of income statements under IFRS 17 is a much bigger change for the life segment than for non-life. In subsequent periods, these initial provisions are accreted before going into revenue. Insurance revenue under IFRS 17 is no longer equal to the premium received in the period. The new standard requires profits to be recognized as insurance services are delivered rather than when premiums are received. This will provide what you might call a run rate, if you will, of insurance contract profits over the duration of the policies. Again, this is a far more of a change for the life segment. Overall, the change to IFRS 17 revenue is not as impactful for short-term lines of business, but will be most impactful for the life and composite reinsurers, where discount rates will play a role.
Mahesh, turning to you, can you take us through some of the more significant changes in key performance indicators?
Yeah, under IFRS 17, the terms under IFRS 17 are generally the same. However, the definitions can be different and they require interpretation. So for P&C insurers, the most significant change is the combined ratio, whereby they're now using discounted combined ratios. For life and health companies, there's been the introduction of the contractual service margin, which one could say replaces the previously known embedded value calculations. So these are now an audited amount which is declared in the financial statements along with the risk adjustment as well. So this changes for life companies with the composition of the life reinsurance segment, the leverage calculations whereby companies are now including the CSM in the denominator.
How is AM Best approaching these changes as you deal with companies that have different standards?
We already look at companies with various reporting standards. So across the globe, local standards vary. The interpretation and the use of those standards are quite different from one country to the next country. So we evaluate companies on an economic basis. So from that perspective, IFRS 17 is no different. Albeit we do acknowledge that there are some material differences when it does come to IFRS 17 in terms of the terminology and language that is there. And with that, it requires interpretation going forward just to make sure we're looking at companies on a comparable basis.
That was Antonietta Iachetta, Senior Financial Analyst, and Mahesh Mistry, Senior Director and Head of Analytics in AM Best London office. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.